Hello and welcome everyone. I'm just going to give everyone a few opportunities to settle in and get ready for the presentation today. Before we begin, I'm going to conduct a land acknowledgement. My name is Linda Griffin and I'm the Education Programs Coordinator with BusinessLink. I am going to start by saying we acknowledge and respect that we are on traditional land, meeting grounds, territories, gathering places, and traveling routes of Treaty 4, 6, 7, 8, and 10, and the home to many First Nation, Métis, and Inuit people. In the spirit of reconciliation, we acknowledge the lands of those who've come before us, reside here now and in the future. I'm also going to do a little housekeeping with everyone. So if you have questions throughout the presentation, you can go down to the bottom of your screen and you will see a Q&A indicator at the bottom of your screen. You can click open the Q&A and ask and type your questions in there. If you want to chat, say hello and introduce yourself, you can do that in the chat box over next to the Q&A. In the chat box, I'm going to insert handouts for today's presentation. And at the end of the presentation, we're also going to insert a survey link so you can complete a short survey about the presentation today. We are not handing out PowerPoints or sending PowerPoints to anyone via email. However, you will be able to watch a recording of this session on our YouTube channel within 2 to 3 business days. You can head on over to our YouTube channel and you can watch that unfold in 2 to 3 business days as well. So I'm going to get going by introducing our speaker. Hi, Karen. I know we were busy trying to get loaded and ready to go today. So thank you for that.
Thank you for having me.
No worries. So I'm just going to do a little introduction. Karen has over 25 years of business experience working as a GM, CFO, controller, chief accountant, auditor, and accountant for several Edmonton and Vancouver-based companies in the industries of transportation, steel building, manufacturing, education, oil and gas, and so many others. She is semi-retired but continues to operate 3 small businesses: Sticks and Associates, Strawberry Farm and Friends, and Skiers with Sticks. She's an active volunteer in the community, leading and implementing initiatives in many nonprofit boards, including CPA Edmonton Chapter, Parent Council School Boards, the McGrath Heights Board, and the CPA Financial Literacy Program, like this one, and volunteer tax programs. She is active in education and was a moderator in the CMA Strategic Leadership Program for 10 years and a sessional instructor for the University of Alberta. She is busy, busy, busy. She has competed in long distance running events at the Canadian National Championships and for the University of Alberta and the province of Alberta. She plays musical instruments, piano, ukulele, flute, alto sax, and writes books, stories, producing musical, instrumental, and vocal CDs. Oh my God, Karen, I could go on, but we need to get going. We need to get going. So if you have questions about who Karen is and what she does, you can throw that into the Q&A. But let's just say she's a Renaissance woman, and she is here today to talk about the money side of business. So thanks for joining us, Karen.
Well, thank you very much for having me. I just want to welcome everyone and make this as interactive as I possibly can. Again, if you have any questions throughout, please interject by raising your hand in the chat area. I'll try to watch it as much as I can. I understand, Linda, you're heading away right away, or should I be watching that, or are you here to help with that?
Both Ashley and Julian are on to help with things.
Okay.
I'm going to peek in. I'm away for about 15 minutes. Everyone, if you have questions, please stand by for about 15 minutes. Type them into Q&A and we'll get to them in about 15 minutes time, about halfway through the program. I'll be peeking in. I'm on a team meeting call as well. So I'll peek in. Go ahead and get going. I'll put handouts in chat.
Okay. Thanks again for coming, everyone. Well, we're going to talk a little bit about the money side of business today, and really what that comes down to is we're moving along with our businesses, and we get very involved in the operations side of it, and sometimes we forget to stand back and take an overview or look at what's going on to see if we can tweak things, make things a little more profitable, be a little bit more aware of what's going on in a business. So if that's okay with everyone, I'm going to proceed to these questions. These are common questions that business owners tend to ask. Well, what is financial management? What tools can help operate my business? How do I determine if a product is profitable? What is my most profitable product? Which customers are generating most profit for my business? And why? Why do I need a budget? And how do I create and use a budget? And then what reports would I need to monitor my progress? Overall, how do I tell where my business is heading? Okay. Looks like my screen is frozen. There we go. We're back on track. So let's start first with what is financial management? So it's really the ability to track your performance, analyze your results, and take action. You're going to focus on profitability and other business goals. You're going to use the tools of financial management. And those are in such reports as financial statements, budgets, forecasts, and industry benchmarks that we can work with through the use of ratio analysis. So first of all, what is financial management? So financial management is the managing of your product and customers within your business to produce, and you'll be producing timely reporting, budgeting, cash analysis, and project and trend analysis. So what you're going to do is you're going to start gathering some information, making it fairly straightforward and simple to report on a timely basis so that you can react and tweak what you're doing with your products and with your customers. So first of all, how do you determine if a product is profitable? Well, the first thing you need to do is you need to start brainstorming. You need to come up and list all the products that you have. So for example, if I'm in a business such as Strawberry Farm and Friends, I have a number of vegetable products that I'm selling. Now, I will say list off honey, list off carrots, corn, all of those, and I'll come up with what my gross sales are for each of those products. And then I'll identify what the cost is related to that product of putting that product together, which then in turn, the sales minus the cost of goods sold will be a gross profit that I have for each of those products. So then I'll just sort the products and list them out by their gross profits. So how do you actually determine if the product is profitable? So what you'll do is you'll take your gross profit and divide it by the gross sales for each product. So for example, say I'm selling a batch of carrots for $10, and I somehow determined that the cost of me producing those carrots is about $6. So I'll simply take the gross margin, which would be $4, and I'll divide it by the gross sales. So I'm making a 40% gross margin on that product. So once you know how profitable each product is, what can you do? So it's great to know that you're profitable, but are you competitive? And so you want to start comparing your products to the pricing in the market. So as a simplistic example, I'll have some other vendors at a farmer's market with me who are selling the same product. What are they selling it for? And how do I compare with them? And I may have to adjust my pricing so that I can sell more or less of my product, depending on what I see my competitors doing. So you've really got to focus on marketing and delivery methods for only your most profitable products. There is an instance where you might reconsider Sometimes you find that some of your products are complementary to others. Without that product, you wouldn't be able to sell the other product. So before considering to drop unprofitable products, consider what they're contributing to the overall mix of your sales. But ultimately, your profits absolutely have to be profitable or serve as a loss leader. Similar to what, say, Costco does with their $1.50 hot dog and their $7.99 chickens. Those are a draw to bring people into the store so that they'll buy the more expensive products. But mostly people will leave with one of those products, and it's just a marketing cost that Costco is paying to bring the customers in to sell some of their more profitable items. So next, so how do you determine if a customer or a customer type is profitable? Simply list all your customers, much like you did with your products. Brainstorm all your customers if you don't already have a customer database, customers and customer types, and identify a typical shopping cart per customer. And then identify the gross profits for each customer. So the gross profits being, again, sales minus cost of goods sold is gross profit. So then you can identify the gross margin for each customer, and the gross margin will simply be the gross margin dollar amount divided by the gross sales dollar amount. And then you can see which of your customers is bringing you the most profit. So once you know how profitable each customer is, what can you do? Well, you can use Excel to sort your customers by gross profits and gross margin. So then you can rank them in terms of how profitable they are. You can then focus on marketing and delivery methods on only your most profitable customers and consider dropping unprofitable customers. Again, you have to always look at what is the downside to dropping a customer before actually going ahead and doing it. So let's talk about reporting now. We've talked about gross margin and profitability, and we've talked about it in terms of product and customer. So can we look at our overall reporting method to then see how the business is doing overall? So the three primary financial statements that most companies engage in are: one, the profit and loss statement, the balance sheet, and the cash flow statement. The profit and loss statement is, of course, important because it relates to your gross margin or your gross profit with all the rest of the expenses deducted. Your balance sheet is a point in time. You're looking at how much you actually have as physical assets and physical liabilities. And then your cash flow statement is reporting on how much cash your company is using and how it's using it. And it can differ from the balance sheet just based on the timing of the reporting of when you're recognizing your profit based on when you're collecting your receivables from your customers. Another key way to manage your financial viability is through profitability ratios. So they're selected and tailored for each business. And we're going to go over just a few of them here. We're not going to go through all of them, but what's so important about profitability ratios is you can compare yourself to other businesses. So it's really nice to be able to compare and see whether you're at industry standard. And another reporting process to add is budgets and forecasts. And those can be reviewed monthly, and those can be reported on graphic charts to allow you to decide whether it's important to pivot and move in a different direction. I see there's a couple questions in chat, so I'm just going to pause and have a quick look. Is there a formula for businesses that sell a service versus a product? Yes. In answer to that one, for sure, you just calculate it the same way. you have to try to come up with a cost for the service, and you do it pretty much the same way as for a product. So you'll have direct hours input into the service, and you know what the charge is on those hours. So that becomes your cost of goods sold. Your sales amount is how much your services are charged out for. So then in turn, your gross profit is the gross margin that you make on that service divided by the gross sales.
Just a little interjection here on service-based businesses as well. One of the things you can really think about with the service-based business is packaging your service just like a product would be packaged as well. So if you're in a service-based business, you can package your service like a product. You can say, okay, I'm coming in, maybe you're in the massage business or whatever that may be. You can take that massage and you can say, well, I'm going to bundle it into a product. You will, subscribe monthly to our massage services. And for so much a month, you get one massage a month. Massage Addict does that kind of work very well. Another great resource if you're in a service-based business and a lot of what you do is based on hourly, is to head into the FreshBooks website and download a free ebook there called Breaking the Time Barrier. That can give you some ideas on how to sort of get out of the hourly services and into more of a product mindset for your services, if that helps.
Okay, that's great. And for example, another service-based company would be providing accounting services. And so to expand on what Linda is saying, there's any number of service-based businesses that you can think of how to market and think of it as a product. And what kind of accounting services are you marketing? But there's always a cost attached to it, and to simply make sure that you're always covering the variable costs associated with that product. In other words, if you're not covering the basic costs that you incur, you have to question whether it makes sense to be in that business. Okay. Can you describe a design art business model? A design art business model. That's a tougher question. I think I'm going to ask you to come back with what you're looking for specifically. This is Darlene that's asking this question. So we'll come back to your question, okay? And then Camelia, for a home-based business, how do I calculate all the costs like utilities, car expenses, and the price of the product? Okay, so that is not necessary to include in the basic gross margin of the product. The first thing that you want to do is to calculate all the direct variable costs to the product. Some of the overhead costs that can be applied to other products will be shared amongst the product that you're providing. So that will come next. The very first thing you want to do is to figure out whether that one particular product is profitable based on what you actually have to spend to add it to your line. So let's go back to something simple like carrots. I mean, in very basic language, you'd be costing your carrot seeds and the labor to plant them, I think, for your direct costs. So it's a direct labor and materials cost. Other costs that go into it is the soil that you might have to add for that particular crop of carrots. But things like overhead, such as utilities that might be spread across a variety of products, can be added in later. And you'll see when we get further into our presentation what I'm talking about. So we'll save that for later to finish the rest of your question. So let's talk about, again, we've talked about this without showing you the calculation. the gross profit and gross margin on a product. So let's add up all of the products that you're selling as being $20,000 less the direct cost of goods sold that you're applying to that product. You're left with a gross margin of $11,000. So you can see that the division on that is you're making a 55% markup on that. And that sounds good initially, but you've come up with some questions that are valid in that you do have other expenses in your business. And how do you relate that in with the product? That can get fairly complicated. It can be a ratio allocation method. You can do it based on number of customers that you have in that product. It can be based on volume of sales of products compared to others, that sort of thing. So now we're adding in some further operating expenses. Now, further operating expenses would be some of the, like what we were talking about, expenses that don't attribute all to one product. So these operating expenses get divided up amongst your products and then included to lower the operating margin and give you a 30% margin once you start to consider all the extra costs that you're incurring. And this is a bit of an art. It's not a science. You have to use your entrepreneurial sixth sense in some instances to help with the actual mathematical calculation. You know, as an entrepreneur, which of your products are helping. For example, you could look at bringing in a product that's actually produced by someone else, and you could wholesale it, and you'd be making a gross margin on that. And you might find that doing that is more profitable than actually physically manufacturing it yourself. So there's different ways to look at this and move forward. So the last thing is to take the final sort of tax and interest expense and come up with the overall net profit. This is a really shell look at how you're doing this, but you can see this product first started at a 55% margin. And then once you started allocating other expenses to it by using an allocation method, it's now looking like it's contributing 20%. Because you're taking a look at what other costs you have, and you definitely have to share those. Now let's take a look at profitability ratios and how those can help you determine whether your business overall is profitable. So there's two here that accountants like to use for business owners, and one is called return on assets, which really means what you make on everything owned by the business. Now you're going to find the asset number on your balance sheet, and the return you're going to find on your income statement. So it's basically the net profit divided by your total assets. And then the other thing that people like to look at, and accountants like to impress upon business owners, is the return on equity profit, which takes a look at the net profit based on the owner's equity. So really what that is, the owner's equity is not just the assets, but it will include the assets in any other funds that the owner has invested in the company. So generally speaking, the higher the ratio, the better on all of these things. So that's something to consider. We're going to be going through a couple of examples here. But before we do that, we want to talk about the different mechanisms we use to manage success. So the next thing we want to touch upon is budgeting. Why you would need a budget. A budget is a plan for the future, and when you put your plan for the future in writing, it becomes a benchmark for you to measure your success and how you're achieving your success. And it also allows you a point in time to refer back to, so that if you think you need to pivot or do something different, you can definitely do that. Now, what you'll do along the way is you'll have some actual figures. You can see there's an actual column, a budget column, and a variance column. So in this instance, you can see this is the profit and loss statement, and you can see that the sales here are an actual of 45,000, whereas your budget was projected to be 40,000. So that means you've done better than what you thought you would. In turn, your cost of goods sold have to be higher because your sales are higher. And it looks like you haven't done as well as you have, as you should have, but you have, because your sales were higher. Your operating expenses, nicely enough, have continued on the same. Your taxes have increased a little bit because your bottom line is higher. The more money you make, the more taxes you pay. So if you look overall, your variance is favorable because you sold more and you sold more efficiently. So your cost of goods sold stayed in check, and your operating expenses didn't go up. Everything went up in a variable sense rather than a fixed cost sense. So you're making $2,150 more in this instance. Let's take a look at the balance sheet. The balance sheet, as I mentioned, was you're looking at where you are at a point in time. You're looking at all your assets and your liabilities and your owner's equity. So basically what you're seeing being highlighted here is everything is consistent here except for the cash. Now the cash is higher for some reason, and it's probably higher possibly because your sales increased and your costs didn't increase more than your sales did. So you can see the variance on your balance sheet is showing a positive cash intake because of that, of $2,150. So you might wonder, if you haven't already done one of these, how do I develop a budget? So what you like to do is you like to first think about your own goals and your own aspirations. Then what you do is you use your previous experience to start coming up with a budget for your upcoming year. The other thing you want to be doing is looking at industry benchmarks and adjusting benchmarks for your local competition. And you can involve others in the budget process. And a budget doesn't have to be perfect. It just has to be a starting point, because it's a plan for the future and it's your ability to plan for change. If you have a starting point, you can take a look at how things actually end up going for you and pivot as you need to. That is the importance of a budget. It's a plan for the future. Doesn't have to be perfect, but it will help you to gauge your performance. So how do you use your budget to manage your business? Well, you saw we were looking at variances before. That's a really great thing to do. And you need to do that on a timely basis. Generally speaking, once a month is a great benchmark for that, to look at things. And if once a month becomes too much, choose once a quarter. Once a year is almost too long to wait, because you're starting to miss any cash flow instance problems or anything to do with any product sales that you could address quickly. So you need to come up with a time frame that works for you and for your business. So you can analyze your budget variance reports as soon as you possibly can, and try to really understand why the variances are occurring and look for unexpected trends. And then you can get into using graphic charts for trend analysis, and a picture of what's happening is really, really nice to see. A budget should never change because then you're losing your benchmark comparison for what's actually happening. There's another thing called forecast that you can use instead if you want to alter where you're headed. So just to reiterate, managing your budget variances, they can indicate sales and marketing successes or failures when your sales are higher or lower. They can indicate changes in your competition, previous lack of understanding of the market, and there's things beyond your control that come into effect, such as weather, economic, and market changes. And then there can be labor issues that you couldn't have controlled, or you want to control better, and this is your chance to do that, is when you're looking at the variance analysis. So why do we look at cash analysis when we're operating a business? Because cash can vary from profit, and the reason cash varies from profit is that you have a difference between, one, collecting your revenues, and two, paying your bills. And what you can glean from this is, if your cash starts to be a problem, you can look at stretching out some of your payments and speeding up some of your collection. And if you have a high accounts receivable, that can use up your cash very quickly and can cause failure. So it's really, really important to stay on top of your receipts, and also to keep your expenses in check and to not stretch them out unduly, because that can preclude you from getting proper and good arrangements with your suppliers. I'm just going to turn to the chat and see if there's any further questions. Okay, I think we're good to continue. So I talked about using graphs. Now, this is an example of a graph that helps you see what's going on with the cash. So you, in your budget, you had projected that the cash was going to be consistently rising because potentially your sales were going to be consistently rising, and you're going to have no trouble whatsoever collecting your accounts receivable. You weren't going to be paying your bills except for on time and within the original plan. But you can see what's happened here. The budget, the dark blue bar chart, is being shown as your cash is consistently rising, and by June you're sitting all the way up in the $50,000 range. Whereas in actual fact, by June, you're only sitting at $22,000. This is really important because you have a shortfall of cash for your business at this point, and you're going to want to take a look and see why that's happening. Now, what I previously mentioned is, it's possible you're not collecting your accounts receivable, and it's possible that you paid for a number of things up front. And it may be that you have a plan in place such that it's going to be okay. You know your accounts receivable are all going to come in a few weeks or a month or whatever it is. But at least this triggers you to ask the question, what's happening? Why is my cash not going according to budget? So I talk about forecasting in conjunction with budgeting. Forecasting is a movable budget, really, is what it is. Now, budgeting is typically for 1 year, and your projections are typically for 2 or more years. And so you'll forecast out into the future and come up with a plan that way. The financial statements and ratios are the tools that you get from your reports. And as we said, the actual results are often going to be different than the projections. And the key, like we said, is to understand simply why the results are different. But forecasting is brought into effect when you see your budget isn't being met, and you might want to adjust your budget, but you don't really want to because you want to keep it as a benchmark. So you'll introduce something else called a forecast. Based on what you now know, here's what the budget will look like. So again, forecasting is simply showing where the business is heading. You're going to use trend and variance analysis, and like we said, perfect forecasting is super difficult to achieve. Again, budgets and forecasting are simply a plan in writing, and as long as you have a plan, then you can start making changes as you see you need to make changes. So here's another graphic representation that you can see is helping you take a look at what's happening with your sales. Now you can see in the budget here in the chart, it was a chart that took you from January through to July, and the sales were supposed to trend upwards to March, and then they were supposed to level off at $60,000. Actually, that's the actual. Yes, that's the budget. Now the actual, you see what's really happened here is that it started out a little less than budget, and it's ending up being quite a bit more than what you ever thought it would be. Now, rapid sales growth is good in many senses. It means that there's a demand for your product, but there might be messages that you're finding, or there might be a message in that for you. There's different reasons why sales can grow very, very quickly. One, it could be your product is underpriced. Two, it could be that you are just a marketing machine and you've done way beyond what you thought you would be. It was time for the sales to go in this way. It could be that you don't really have a lot of competition, and so you're able to quickly expand on the sales and capture a niche in the market. So there's various reasons why this could be happening, and it's really a good idea to take a look at that. The one thing that can happen with rapid sales growth, though, is that your accounts receivable can start to be collected on a less timely basis. And it's very important when you're focused on sales to not lose sight of the fact that cash is also what's going to help you continue to grow your business. So along with a rapid increase in sale generally comes an increase in costs and things that have to be paid for. So you have to watch that carefully and make sure that your accounts receivable don't get way out of hand. Now, in this particular graph, it was sort of showing that accounts receivable should show a steady state of $80,000 per month, when in actual fact, you see them increasing slightly. Now, with this situation, you would generally expect that accounts receivable would increase if your sales are increasing, and to the same percentage degree that your sales are increasing. So you could take a look at it from that standpoint. I see there's some more comments in the chat, so I'm going to have a look at this. Okay, nothing critical, so we'll keep going. Again, if you have any thoughts, concerns, questions as we proceed, please let me know. So like I said, your accounts receivable, generally speaking, your accounts receivable should be something that you're keeping a very close eye on, because it's going to help you fund your business if you're collecting your accounts receivable on a timely basis. So I'm coming to the conclusion, and I just wanted to draw everything together here for you. We've been talking about the money side of business, and in a way that we want to talk about reports, ratios, and results. So what we're looking for here is to take a look at the reports of the income statement, the balance sheet, the cash flow, and we want to inject budgets and forecasts in with those reports. Remembering that budgets are never changed, whereas forecasts are changeable as you start to pivot and see that your results need to be are different than what you originally thought they would be. It helps you to plan into the future without changing your benchmark. So you can still compare to your benchmark budget, but the forecast will help you to move forward. Your ratios of your gross margin and your gross profit were really beneficial to take a look at whether you should be keeping the product, whether the customer is a profitable customer. A couple other ratios we were looking at is based on what you were investing in the business, you were looking at the return on assets and the return on equity, which were two longer term ratios that you look at. But your short-term ratios here are whether you want to keep the product or keep the customer. The other two ratios are you've injected some money in the business. You want to make sure you have a positive return based on what you've had to invest overall in the business. Now, your variance analysis is simply comparing your actual to the budget or your forecast, and your ratios as compared to the competitors, and also as compared to what you wanted those ratios to look like in your budget. So that's a summary, a general summary of what we've discussed. Some of your questions have been very good in terms of, well, how do I actually cost my product? And there isn't a scientific answer to that. You have to take a look at it critically, but the first and foremost important thing is any direct material or labor costs that are required for the product should be recovered immediately, or you would ask the question, why are you in it? Some of the overhead costs, the costs that can be shared with other products, aren't necessarily needing to be covered in the short term, but definitely in the long term. Okay, is there an Excel, Chris is asking a question, is there an Excel template for a business that is in the very early stages of startup?
Are you looking for cash flow template, Chris? Startup costs and cash flow template?
I mean, it's easy to create a template in Excel based on where your business is at. But if you're looking at some of the basic questions that we're asking here about gross margin and gross profit, it's very easy to create your own template. And if you're familiar with Excel, or to get some help creating that, the template that you're also looking at for budgeting, again, those will vary by business. There are some, if you go into your Excel, you'll see that there's a gross margin, gross profit template. Just a general income statement of revenue less expenses is another thing that you can create as well.
I've put into chat for everyone the cash flow templates used by Futurepreneur Canada. If you're looking for financing with Futurepreneur Canada, you're an entrepreneur less than a year in business, under 39, and looking to access mentoring and financing, you would actually use those templates as part of your business plan to apply to the program. But they have great tutorials with them. They're great cash flow templates, and they give you a sense of where you need to be without you having to build them yourself. So there is also a question in Q&A. Hi, Griselda. I saw that. I was going to ask Karen. Let's say there are product A and product B. Product A is $1,000 gross profit over time, but the gross margin is 30%. Product C is $400 gross profit over time, but the gross margin is 45%. Which one to focus on?
Yeah, that's a good question. I think in the short term, I mean, it depends what your objectives are. If you're in wanting to look at raising more cash in the short term, you would probably, and it also depends on volume, right? I mean, the gross profit, you can see that the dollar amount in the volume that's being sold and the percentage. It also depends if the products are complementary. If they're complementary, you'll focus on them equally. If one is easier to promote than the other, you might decide if the 30% one is easier to promote, you might decide in the long term okay. I'm just reading your question again. There's so many variables that go into that question. So okay, it says product A is wedding photography, product C is birthday photography. Okay, so you're saying wedding photography is you can charge more for it, but it's not as profitable as birthday photography. Well, weddings are seasonal, generally speaking. Birthdays can happen throughout the year. I wouldn't focus on one without the other because I'm thinking that those are complementary products, and I would say that one is probably promoting the business of the other. Certainly weddings might promote birthday products as the married couple start having children or whatnot. Birthdays, they complement and promote the weddings because you've been there, and there might be someone who has attended the birthday party that would look to you to having a wedding photographer. So there's no straightforward answer to that question, but you've definitely got complementary products going there. So I would say focus on both of them, and to what percentages, that would be at your discretion.
I would also think the wedding takes much more energy and time than the birthday. The wedding is so fussy, right? The bridezillas and travel times and all kinds of stuff that's necessary for weddings. It's a long haul to be at a wedding, whereas birthday parties are spontaneous events and fun events and happy events that probably require less time and energy to do, and can be, I don't know, quick turnovers. If I looked at that as the potential for my business, I'd also look at where is more of the competition happening? Is there more competition in wedding photography? Are you actually capturing the amount of time it takes you to get that client at the front end of the wedding and to deal with all the time and questions and issues throughout that project? Are you really? I would ask the question from a time and energy and travel and everything else perspective. Am I actually making that money when I calculate for time? Am I actually making that money when I'm calculating for competition and what it takes to get that client? Might be sorts of things to think about there as well.
Definitely. That means properly costing, some of your marketing in with the product cost, not just looking purely at, the direct costs of it, but I mean, the marketing of it is somewhat of a direct cost. That's very valid. So are there any other questions at this point? I'm just going to keep moving forward. You can see we've come to the end of our presentation, and we have some resources here. Linda may have some other things that she'd like to share with you, and I'd certainly like to entertain if you have any more questions that you'd like to share with everyone, any experiences that you could share with people that might be valuable in terms of reporting, variance analysis, surprising things that you've discovered along the way. One of the things I'd like to share just before Linda, I was just going to say, one of the things that can happen to entrepreneurs is they get so invested in what they're doing and they love what they do, is that they forget to look at the financial aspects of what they're doing. And there will come a point in time when you are being pulled in a direction other than your business. And then you'll have to make a critical decision as to whether it makes sense to continue on as you are, And you can simply do that by starting to look at it very critically through this financial analysis method that we've shared here today. Linda, did you have something to add here?
Sure. Yeah. Thanks, Karen. We're here sitting in a session about numbers and cash flow and looking at the budget and looking at all the analysis, but there's a lot of other decision making that also goes into it. So this is your dashboard. These are your dashboards that you're looking at as your starter point. This is the starting point where you say, okay, here are my revenue streams, and pick maybe the top 3 to 5. You may have hundreds of them or more, but pick the top 3 to 5, do an analysis on those and say, well, here's where we really are starting to see where we're focusing our energy. Let's take a look at those by inserting the numbers first before we make any decisions. So this is where you start to put the numbers into place on a dashboard that you can start with some sort of objective analysis. So you're looking at them and you're saying, here's where we sit now with these particular products or services. Here is the calculation of direct costs. Here's the calculation of variable costs. Here's the calculation of time. Here's the calculation of everything. And this is what's left over at the end. This is how much of it we're selling and how often. And you may discover that there are some products or services you're selling where if you calculate your time, you calculate your costs, you suddenly realize that, oh my gosh, I am paying these people to be my client. I'm not making anything off of this once I start to do the analysis of it. So, right away, you have to think about some stuff with your products and services. Am I going to keep this thing and use it as a loss leader and bundle it with something else and maybe turn it into part of a bigger package? Am I going to ditch it altogether because really the time and energy we're wasting here could be spent better on focusing on the other 3 or 4 products or services that the company is really wanting to go forward with? So this is about the ability for you to look at numbers so that you can narrow your focus and understand where your company should be focusing its sales and marketing directions and where it should be focusing its time and energy. I noticed in my business, just like the wedding photography business, in my business that I own, we had a product that looked like a large number. It was a one-off product service. We still offer it, but we understood that this product or service, even though it looked fabulous, and at the end of the checkout process, it was like, woo, look at what this number is at the end of checkout. By the time you factored in time, cost, energy, and the cost of marketing to get it, we decided that that was not going to be the primary focus of our sales and marketing at my company. We did a few things with that particular product or service to eliminate some of the time factors on it, eliminate some of the cost factors on it. So rather than ditching it altogether, we just found ways to streamline it to eliminate some of the costs involved. So that was one way we ramped up that product service in my company. Another way we did it was we said, okay, let's not make it the main focus for what it is we do. There is another product or service in our company that people have to keep coming back for over and over and over again. It takes us no marketing effort to do it other than taking the people we already have and letting them know we have it. We know it has to be done year after year and that these people have to go somewhere to do it. Let's make us the people they go to do it. And the margin on it was so high, even though the take home on it was so low. The margin was really high, the volume of it, the fact that we didn't have to go out and market it in heavy handed ways just made sense for us to really focus at the checkout with everyone we did at the checkout. We made sure we focused our marketing efforts on them coming back to us for the secondary product. Even though it was a smaller number and it happened only once a year, it was like candy for my business. So that was a long-term goal, was we're focusing on that product or service over a 2, 3, 5, 10-year period of time, because then we will have a built-up client base coming back repeatedly, giving us regular monthly revenue. And we actually built some software as a service around it once we figured that out. So these are great ways to figure out you know, is it something we want to keep our focus on? Is it something we want to shift our focus on? Is it something we need to rethink our delivery strategy on and our marketing strategy on? So when you're talking about all these numbers, all of the things we're talking about is the base starting point for how you make decisions as an entrepreneur to move forward with the products and services in your company. And you can play with this stuff, play with it.
Okay, I totally wholeheartedly agree with everything that I've heard there. I see there's one other question, and we talked a little bit about when is it necessary to eliminate a product or a service. There isn't a simple answer to that question, but definitely we've provided some guidelines here, and I'd like to reiterate those. If you are spending more to produce a product than you're receiving back in sales, so that your gross margin is a negative amount, you have to critically ask yourself the question, why are you paying to do this? What is it that it's doing for you? If you're constantly losing money with this one product or this one service or this one customer, why would you continue? If it's to be used as a loss leader, that's one thing. If you think it has great potential in the long range, you need to set time barriers on it so that you're not constantly thinking, well, it's gonna make it, it's gonna make it. This year is the year. You need to say, well, after a period of this number of months or years, that's it. If it's not profitable, I need to start refocusing my time elsewhere. Someone says here, Hanukkah, it says, I've recently started an alteration business service. The profit margin is slow and spread out. I am contemplating on creating a product to gain better consistency with profit. As a new small business owner, is it too soon to do so? Boy, if you've got some discretionary time, then you can use that discretionary time to do that, or you can use that discretionary time to market your existing product more effectively. I think in answer to that question, if it were me, unless that product is going to complement what you're doing, I'd be careful of spreading myself too thin. I'd try to focus on what I've chosen as my mainstream business. Okay. Okay, so I think, Linda, I'm pretty sure that's, should we cover?
I agree. I think we've covered a lot. Thank you everyone for participating today. You'll see I put a survey link into chat. So I'm going to put that back into chat one more time. Please take 30-40 seconds to complete the survey. It doesn't take long. It's the feedback that we provide to Karen and to the CPAs about the presentation, and it helps all of us know how we're doing and what we can improve as well. So it's our continuous improvement. I do have a link there for you. It's very quick. Karen, thank you so much for presenting today. I appreciate that very much. You always have insight, and as a business owner, you bring that insight to it as well. So it's great to hear your stories and your feedback on that too. But numbers. It's hard to get us all excited about it. But thank you for sharing that with us, because you managed to do that where so many don't. So thank you for that. I'll ask that we stop the recording if we could.